Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Housing and real estate and mortgage prices, mortgage interest rates, et cetera, are probably the topic that people spoke about the most over the holidays. And I think lots of people are giving thought to what they're going to be doing in regards to their mortgages and housing coming up in 2024. And so I thought I'd reach out to an expert in this area. Ted Tsiakopoulos is a senior economist, a best-selling author, and a university instructor, and he's a very sought-after expert speaker on the real estate industry. His extensive private and public sector experience analyzing real estate and financial markets enables him to extract value-added insights from data to help us all be empowered in what we're going to do in regards to renewing our mortgages, going short or long, and what we're going to do with our housing. Ted, welcome to the show, sir.
Thank you, Brian, and great to see you again.
Great to have you back. So, everyone's wondering what's going to happen in 2024 with interest rates and housing prices. What do you think, sir?
I think that there is some pressure on prices. There continues to be pressure on housing prices. I think that buyers are in many ways sitting on the sidelines right now, waiting for cues, I guess, from the Bank of Canada. And I think that, why buy a home now if you believe prices still have some room to fall, or if you believe interest rates will be a lot lower 6 months from now. So buyers are on the sidelines. Prospective homeowner, existing homeowners, prospective investors, a mixed bag there. Investors as well on the sidelines, thinking there are better days ahead. So this is really restraining demand in some ways. On the flip side, you do have investors who are, in some cases, are walking away as well, right? From
walking away.
Well, basically, if you've bought a new condo and you haven't closed yet, or it hasn't been built, there is some evidence out there that some investors are actually, exiting, whether it's a new condo or that hasn't been built, or an existing condo. Maybe if it's a new construction condo, they're assigning that unit. But it's really, the shock in interest rates that a lot of people didn't anticipate. It's prices having fallen and things having to be reappraised. And, obviously, as an investor, you may have been qualified on a mortgage of X amount, but prices have adjusted down. Appraisals have moved lower. You don't qualify now. So again, it's a market that's a lot more better supply than what we've seen in many years. So I think that in itself suggests that prices probably have a bit more room to fall. But at some point in 2024, we will see a bottom on house prices, and we will see demand start to pick up. The real question is what are the risks?
When we last talked, you had just released a book. I think the title was Property Trendsetters, Preparing for the Unexpected. Have your potential scenarios come to pass, or are there more unexpected scenarios still to come?
Right. Yeah, we had a really interesting conversation, Brian. I highlighted 4 disruptions that the next generation of buyers and renters should keep their eye on, and these are disruptions that they need to manage. The first big one, of course, deglobalization, and that's here, real time. We're living it. And if anything, what we suggested in the book was that it would, snowball even more so, and it would stay with us for a little longer. And of course, when the book was written, of course, the Ukraine outbreak, the Middle East outbreak, hadn't happened yet, and here we are. Some of those geopolitical tensions have now filtered down into the trading world, and so the global trading world has become even more polarized in many ways. So that suggests to me in the short to medium term, costs and inflation are likely going to stay pretty sticky because of this global environment. Of course, there was the other disruption, the digitization disruption. We're in the fourth industrial revolution. One of the things I suggested there was that businesses will need to, in a slow growing economy, need to manage costs. How did they do that? Well, they embrace technology. We talked a little bit about robotics, AI. I have to say, I was a bit surprised how much AI has been part of our mainstream conversation. It's actually arrived a little sooner than what I thought. I thought that we would be having deeper conversations in the back half of this decade, but AI has now been embedded in so many sectors of the economy. And 2023, if you look at financial markets, boy, front and center, AI was there. Uh, you know, Aging demographics was another disruption we talked a lot about, and the need for more immigration. And we certainly got more immigration, but one unexpected, one surprise in my mind was how much we opened the floodgates on immigration to deal with the aging population story, and more on that a bit later. But those were the kinds of things we kind of highlighted in the book, and we're just beginning, right? A lot of these disruptions are only going to grow in momentum through the back half of this decade. Yeah.
It's really interesting and concerning. The Eurasia Group came out with risks for 2024, and geopolitical was the number one risk. And they identified, the Ukraine, the Russian invasion of Ukraine and the war there as a number one risk. But it's something that we've lived with now for 2 years. But then they did talk about this Mideast war, and that it could escalate beyond just Gaza, and we've seen that just in the last week with what's happening in the Red Sea, and no, not the Red Sea. Sorry, I apologize. With bombings of ships, and retaliation, and their comment was that could really accelerate inflation with a whole new supply chain disruption, and maybe that's what you're talking about. But then the third risk they talked about, the third war they talked about, which I don't think you and I spoke about at all. I'm not sure if it's in your book, but the risk they talked about, the third war they talked about, was the war in the United States amongst itself, that they thought it was as extreme as it's ever been, other than the Civil War in the past, and that polarization and the impact both in the United States, but then what that would have around the world was extreme. So just talking about geopolitical, are we in a more risky scenario today than we were when we last chatted?
Absolutely. As I say, the Ukraine wasn't on the roadmap when we last chatted. The Middle East wasn't on the roadmap. And Brian, we can't rule out the possibility that this tension sort of spills more broadly into other communities. And that's when you get into another risk scenario for supply chains, oil prices. All of these things could really cause commodity prices to accelerate, and of course that will feed into inflation, and perhaps it could mean that central banks are on hold for a little while longer, and that's one risk to the housing market, that rates don't come down, that central banks don't pivot quick enough. And so that is a risk to the demand and the price side of housing, for sure. That recovery may happen a little later in the game. But to be quite honest with you, Brian, we're nowhere near where we need to be when we're talking about housing affordability. I mean, we're still on that non-linear curve, that trend curve. We're not on a linear trend curve, which we need to be. And I don't want to get technical with you here, but a linear trend curve means that prices are growing in the 1, 2, 3% range, not in the 5 to 10 to 15% range. So depending on who you talk to, we need better affordability, and so anyway, geopolitical risk, yes, are here and live, and those pose some pretty significant risks.
And
Yeah.
but how does that impact housing? So, am I correct in saying that supply chain disruptions, increase deficit and debts because of us financing wars in the Mideast and Ukraine? What that does is increases inflation, which means interest rates have got to stay higher longer than they otherwise would. Is that the
That's it. Yeah, that's it. So there's two channels here. There is the deficit channel that you've just identified. So if governments are funding this war and taking on higher deficits, they need to borrow that money. And when you borrow, we've seen what happened with U.S. debt ratings. Those debt ratings drop and rates on that debt go up. Investors won't buy your bonds if you take on tremendous amount of debt. So that's one channel. The other channel, of course, is, we need oil, we need gas, we need food. And when those prices go up, broader inflation goes up. And that means, tougher for central banks to restrain inflation. They have no choice but to keep rates elevated for longer. Yeah.
Fascinating conversation and a little bit scary. We're going to take a break for some messages and come back in just 2 minutes. And we're going to narrow our focus down from geopolitical risks to housing prices and interest rates. Stay with us, everyone. Back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Ted Tsiakopoulos. He is a very smart senior economist, best-selling author, university instructor, and speaker on the real estate market. He has emerged as a speaker that's engaged, inspired, and empowering many different audiences to understand better what's going on in the real estate business. Over his career, his commentary and research has been widely quoted in BNN, CTV, CBC, and as a guest on the Brian Crombie Radio Hour. We had a fascinating conversation a little while ago about his book, Property Trendsetters, which had several different trends, some of which we talked about and some that we're going to continue to talk about. He's got a master's degree in economics from York, and he's also studied at the London School of Economics in the UK. And importantly, his views that we're talking about today are his personal views and not that of his current employer. Ted, housing prices, have they bottomed yet?
We're close, but not there yet. And, as economists, as analysts, we tend to look at specific indicators to give us a sense of where things are going. One important one, Brian, is the sales to new listings ratio. And that's really a ratio that looks at the demand-supply balance in a market. So if in any given month we see that ratio drop below 40%, which means that if in any given month or quarter we're selling less than 40% of new listings in the market, then you're in a buyer's market. That's when buyers are in control of prices, okay? And we've seen that kind of market back in history. So we've seen it during the credit crisis in 08. We saw it in 2017 in Toronto's case, which is some of the data that we're talking about here today, but did apply to other communities. And we saw it following rate hikes in April of 2022. We saw the collapse of that ratio, that sales to new listings ratio. And so that's a really nice leading indicator of where housing prices are going, because a few months thereafter, you do see prices coming off, correcting, okay? And, that's what we saw in the past year. We had a bit of a, hate to use this term, but it was a bit of a dead cat bounce in the spring of 2023, when everyone thought, boy, the coast is clear, rates are not rising anymore, central banks are done. But central banks threw cold water over that, and we saw that ratio reverse to the downside again. And so, we really need to start to see that ratio, that demand coming back into the market, that ratio moving higher before we can expect a plateauing, if you like, a bottoming of housing prices. I think we will see that at some point in 2024, but it really depends heavily on the state of the economy and the job market, interest rates, and when they turn, and of course all the global geopolitical issues that we're being confronted with here today. Yeah.
So the information that you've shared is that housing prices went down fairly dramatically, I guess, in 21, and then went back up again in I guess the first half of 23, and then have come back down again in the latter half of 23. And so that was the dead cat bounce that you described. And lots of people have talked about it being 21 was actually a positive year of housing sales, but 22 was negative, and 23 was this resurgence for about 6 months, but then decline. So given that kind of volatility, how can someone make a decision if you're a buyer or a seller? And what do you think is going to happen in like the next 6 months? What I see is that, as we talked about in the first segment, I get an assignment sale email or a new price on a single family house email almost on a daily basis. But most people are saying that while sales volume is down, selling prices aren't down. What do you think is going to happen?
Yeah, we've certainly seen some strength coming back into the market, Brian, in December. Those numbers aren't out yet. CREA, the Canadian Real Estate Association, will be reporting on those numbers next week on the December and year 2023 number. But there's some anecdotal evidence that the market has picked up a bit in December. I wouldn't put all my eggs on the December number because the market is fairly illiquid. And so when you've got an illiquid market in any given month where you're not getting a lot of volume, prices could be quite volatile. So I wouldn't put too much, value in what happened in December. But I think that, as I said earlier, expectations are playing a very important role here. Buyers are saying, look, I'm not entirely convinced that the war on inflation has been won by central banks, and that's certainly what some of the data out of the Bank of Canada is showing, that consumers don't think we've won the war there yet. I'm not sure that is also translating into buyers thinking prices have bottomed, it's time to move in. We're certainly not there yet, but I think we are a few months away. I think that by the second quarter of this year, we could get signals that rate cuts are coming. And at that point, I think both buyers and investors will likely be moving in anticipation of rising prices. So they want to get in on real estate a little before prices take off. So I think you'll start to see by the second quarter some evidence that prices have bottomed. The real question is how strong will this recovery be through 2024? And I think for some of the risks that we all already mentioned, I think the recovery could be muted, especially if we see a downturn in the economy being a bit more serious than what we thought. What could translate into a more serious downturn? Well, we do have quite a few mortgages resetting, and when those mortgages reset, you could potentially see existing homeowners facing a 30%, 40% increase in their monthly mortgage payments.
Well,
now sorry, go ahead.
Let's get to that in a second, because I think compounding that is that even though you've got these sort of declines of late, still way above where they were just even 2 or 3 years ago, housing affordability is terrible. And that was the second topic that you wanted to address. Can you look at the housing affordability?
Yeah. So
switch to your second slide if you could.
Yeah. So housing affordability is really another factor that we have to keep our eye on to really get a gauge of how strong this recovery is going to be in 2024. And what I'm showing, for people tuning into the radio, they won't be able to see this, but generally, if you look at affordability measures in Toronto, the average household is devoting 80 cents out of every dollar earned to servicing their mortgage. 80 cents.
How can people live if you're devoting 80% of your income to housing? Like, you got nothing left over.
Well, and you know, as I say, this is for overall housing. Now, if you look at single family, it's even higher. Condos, on the other hand, are closer to about 50 cents on the dollar. But nevertheless, you know, an affordable market historically has been comprised of, you know, basically out of every dollar, you're not paying more than 30 cents, right? So it really puts these numbers into perspective. So how are you making these payments? Well, you know, the Bank of Mom and Dad has been there in recent years and continues to be there, of course. But something has to give, because these numbers are only set to move higher as mortgages reset in the next year or two. So where's that money going to come from? Yeah, some of it could come from the Bank of Mom and Dad, but at the end of the day, you know, home buyers will have to reduce their discretionary spending. It's what, you know, Brian, I talked about when I talked about putting a budget and a financial plan together. They'll really need to re-engineer that budget, find savings, determine what is a need and what is a want, get rid of the wants, and find those savings. But ultimately, they will reduce spending. They will not be going out to, you know, the average household won't be going out to a movie or to a restaurant or taking a vacation. So that's the risk, where we actually have the possibility of seeing a more significant downturn in consumption, demand, in growth, and therefore it hits the labor market.
Yeah,
So you don't get the
honestly,
you don't,
I hear
yeah.
you, but if you're spending 100% of your income on your housing, on your mortgage payments, you're not cutting back spending. You're going bankrupt. You're handing back the keys. You're increasing your debt all the time. You're living off your credit cards and increasing your credit line. Like, you can't live if you're spending 100% on your mortgage.
Well, again, that is the case when we're looking at single family housing, right? And this is data from the Royal Bank. But generally, you know, you could see here that condos, you know, you're certainly not spending near that amount out of every dollar. But what it's telling me is that as these mortgages reset, there will be a knock-on effect on the broader economy, and that could be the headwind that prevents this recovery from taking fold as strong
And
as
so
what many
then let's turn to mortgage resetting. What's happening there?
So mortgage resets, you know, as I say, big risk in the next year or two. And you know, Brian, I don't think it's interest rate risk per se. And I say it's not interest rate risk per se because Canadians will do whatever it takes to pay their mortgage. They need a roof over their home. They'll usually default on other credit facilities like your credit card, a auto loan, before they default on their home. But you know, they will pay their mortgage. So it's not interest rate risk per se, as much as I said, it's the hit to the labor market. But why should we expect a big wave of renewals? Well, look what's happened historically. You know, back in 2020, almost you know, 45-50% of all new mortgages issued were fixed rate 5-year mortgages. Okay, because it made sense. Central banks cut interest rates close to zero. And people wanted to lock those low rates in 2020, 2021. But guess what? Those are coming up 5 years later as renewals. 2024, 2025, 2026. That's where we see about 2 million mortgages being renewed. And so you know, that's what we're facing here. And as I say, it will require home buyers to cut back on spending of other goods and services.
But it's interesting, you know, what it looks like is that people have shifted out of variable rate, floating rate loans to fixed rate, but they've gone from 5 years to less than 5 years to 3 years, and so therefore they are getting a fixed rate, but it's a shorter rate, so therefore they're going to have to renew more often.
Yeah, and I think one of the reasons why in some cases over the past 6 months you've seen this shift away from from longer term fixed to shorter term fixed is just this anticipation that, I don't want to lock in for too long if central banks are going to pivot. I want to take advantage of central banks pivoting, cutting rates sometime in 2024. So I don't want to lock in too long, and that way I do take advantage of those shorter rates, lower rates that could be coming. But nevertheless, as I say, I just want to reiterate that I don't believe the risk here is as much as what people have been talking about. It's interest rate risk per se directly. It's, for me, I think the big risk is the hit to the broader economy in terms of less consumption, less spending, and what that could mean for the job market. And potentially the possibility that we see unemployment rates moving much higher, right? And that's when you keep new buyers out of this market. So that's where you get this scenario where the recovery isn't as strong as what everybody is thinking it's going to be.
That's a big risk and a big concern. There's no question. This is really interesting. We're going to have to take a break, though, for some messages, and we're going to come back in just 2 minutes. And Ted has just recently issued a really interesting academic paper on market volatility and the impact of market volatility on the real estate market. And, I think this is one of the issues, is that people say, the level of housing prices and interest rates are clearly an issue, but uncertainty, the risks are more so, because you just don't know whether things are going up or down or sideways. So we're going to take a break and come back in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Tsiakopoulos. He is a senior economist, a best-selling author, a university instructor, and a sought-after speaker, and really smart guy, as it's obvious from our conversation so far tonight. Ted, in addition to this book that I really enjoyed chatting with you about, I understand that you've recently published a paper in the Journal of Risk and Financial Management on market volatility and the impact on home building. Lots of people will understand market volatility from a stock market standpoint, but why would market volatility impact the real estate business and home building in the real estate business?
Yeah, so it's a great question, and we spent some time focusing on this question. And I was happy to collaborate with the University of Waterloo and Urban Sim on this study. But market certainty in the minds of home builders is quite critical. Findings from the research suggest that market volatility creates a lot of uncertainty, obviously, and really drives that decision. Do I, as a builder, initiate a project, go ahead with a project, or not? So if a developer gets surprised by, let's say, a shock to construction costs or a shock to interest rates, because they do require construction financing, and puts a pause on development, or worst case scenario, they cancel a development, well, then this just amplifies the housing supply shortage even more, right? We don't get the housing supply that we need. And there were many lessons learned, Brian, from the One Bloor West project here in the heart of Toronto, and of course, Evergrande, a builder in China, right? What we saw in both of those instances was, both developers maybe didn't have as much cash in their pockets, as much equity in the project. Liquidity was an issue. But if you dig deeper, you'll find that, again, a move up in interest rates, a rise in construction costs, that surprise element was front and center. So the math didn't work, and projects got paused or got canceled. Now, a lot of our audience may not be aware, but builders price a project today, and that's fixed. They can't change that. That's what they've committed to. However, it does take time to build a high-rise condo or a purpose-built rental structure, maybe up to 5 years. And so on your cost side, your costs can actually turn on you quite quickly. They're not fixed. Those can take off. And so you run into real issues, just in the GTA alone, these are two factors that have contributed, the two factors being a rise in interest rates, rise in construction costs, contributed to about 10,000 projects being canceled just in the GTA in
Hold
recent
it.
years.
10,000 projects or 10,000 units?
Sorry. Let me rephrase it. 10,000 units.
Oh
Thank you
gosh.
for catching that.
Thank
My
you.
goodness. Yeah, 10,000 units. My mistake.
10,000 units is bad too, but
Yeah,
10,000 projects would be unbelievable.
will
So
be unbelievable.
10,000 units, and let's put that in perspective. So what Doug Ford, the premier, was saying is that we need I think it's 5 million homes before in the next 10 years, but it's already 2 or 3 years into that time period, and so it was about 120,000 units in the whole GTA. 10,000 would be 8 to 10% of that.
Yeah, I mean, I think we're looking at about 1.5 million new units built annually in Ontario. So it's a huge number. But taking that 10,000 unit count and comparing it to history, Brian, we build about 20,000 apartment units in Toronto annually. We don't have the capacity to build more than that historically. So if you're taking out 10,000 potential units out of 20,000 that we have capacity to build in Toronto, that's 50%, right? So it's not insignificant. It may be smaller relative to where we want to go, that 1.5 million, but ultimately that's what's happening. And that's the impact that market volatility has on the decisions of builders. The other big thing that we found, Brian, was that the yield on a project is sensitive to a number of factors, but the factors that hit top of the list, things like interest rates, not surprising. The term of the loan, not surprising. The amount of equity that a builder brings into a project, not surprising. But the other factor was besides construction costs, interest rates, property taxes. Property taxes was another one of those factors that could put a project at risk of starting, based on what we found. So there were some interesting findings there.
I'd love to read the paper. The factor that I think is one of the biggest issues is time. That it's time and risk of approval.
Yeah, for sure. So the time aspect was there as well. It was it kind of made the top 10 for sure, because there's certainly been a lot of red tape. It's just taking far too long to get a project from inception to completion for sure.
What are the implications of your study on what government needs to do?
Well, it's imperative that policymakers do whatever it takes to create a market environment that's steady, that's stable, that developers and consumers can make decisions with confidence. It's critical. Certainty is critical to the home buying and building decision. Obviously, policymakers can't control black swan events, or those events that we can't foresee, right? Like the breakout of a war. I mean, just to be fair there. But from a macroeconomic policy perspective, Brian, it sheds light on central banks and what they need to do, that they need to be a lot more proactive on inflation and beat it down in a more timelier way to ensure that interest rates don't have to be yanked months later because we're behind the curve, right? Central bankers must also provide, I think, appropriate forward guidance, and we've been doing a good job at that. Forward guidance meaning where are interest rates likely going? But there were some lessons learned through the pandemic that probably there are opportunities there for us to have done things a bit differently. There are also opportunities at a municipal level. I think when developers choose where they want to build housing, what community, they need certainty on what zoning looks like. What does zoning permit to be built, and how dense can they go? How long this development project will take? As you noted earlier, these are factors that are well within the control of municipal governments, and so municipal governments can create a bit more a certainty in that regard. And in some cases, maybe stop using density as a negotiating chip to extract certain concessions from developers. I mean, I think that's at a municipal level, that's a bit more work there to be done. But last but not least, we need policy coordination across different levels of government. Let me give you an example. When the feds come out with a cut, proposing a cut to the GST, so we're going to cut the GST on new purpose-built rental construction. Well, municipalities can't turn around and then decide they will levy a 50% increase on DCs, on development charges, because what's happening there is you're just watering down or offsetting the effect of the GST cut that could have in the marketplace. So we need a lot more coordination between different levels of government in terms of policy making, right? So at the end of the day, Brian, if builders sense that there's more uncertainty in the development process, that adds more risk. And what often happens is developers add a risk premium to the required yield they're looking for on a project. So if you were looking for a 3% cap rate on to build a purpose-built rental unit, or 4%, and you feel there's a bit of risk here in the planning approval process, with zoning, with macroeconomic policy, they could tack on another 0.5%, 1%. So that required yield to move ahead goes up. And so what in effect is happening here is developers are actually setting a higher bar that a project needs to meet before they go ahead with breaking ground on that project. So that gives you a sense of how uncertainty feeds risk and how risk feeds that risk premium yield, and ultimately what the effect could be on the viability of a project.
And given all that, I worry that our supply will not increase the way that we had hoped it would, and therefore we'll have even a worse supply-demand imbalance, and therefore our housing affordability will not improve, and we're going to rob the next generation of the dream of home ownership. And I think it's a real catastrophe. And you were kind enough to share a bunch of interesting slides with us. One slide that I've seen a couple times, and maybe you can tell me whether this is true or not, is that housing affordability, or debt to personal disposable income in Canada, is twice what it is in the United States. So our level of housing affordability is half of what it is in the United States, or to put it another way, the level of debt that we have to carry is twice what it is in the United States. Does that match up with your knowledge?
Yeah, no question about it. Debt servicing costs here are a lot higher for the average household than what we're seeing in the United States. And part of it, a good chunk of it, Brian, is that you can take out a 30-year fixed mortgage in the United States, right? Yeah, and that gives you peace of mind and probably some insurance that there will be less volatility that you need to be confronted with. So in Canada, we don't have a 30-year fixed mortgage. It's a lot lower, and so it creates more interest rate risk for sure. And we're seeing it live, right? Real time. Canadians are paying more to service their debt, and that's what makes our economy, again, more vulnerable in the next 12 to 24 months as some of these mortgages reset.
We're going to take a final break for some messages and come back in just 2 minutes with Ted. And I'm going to ask him, given all this, what the heck can we do? What can governments do to improve housing affordability and make sure that we build these houses that CMHC, StatsCan, build, all the other different organizations, the provincial government say we need to build by 2030. Stay with us, everyone. Back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm having a really interesting conversation with Ted Tsiakopoulos, who is a very smart economist specializing in the real estate business. He's written a really fascinating book that we've chatted about before called Property Trendsetters, Preparing for the Unexpected. And he walked through a couple of trends that he was not expecting, but warning us about, that were really quite interesting. And some have come true and some have come in black swan events that potentially are even worse than the ones that he warned us about, which is kind of interesting. And geopolitical wars are one of the things that have really impacted us. He's also walked us through, how overlevered we are in Canada, how our prices are high but potentially coming down, how we've got the supply demand imbalance in housing, but also in sellers versus buyers in the housing market. We got a lot of challenges, Ted. Given all this, and you're a smart guy, what can we possibly do? What do we need to do to build this massive amount of, whether it's 1.3 or 1.5 or 1.8, different people have different numbers, millions of new housing in the next 8 to 10 years? What can we possibly do? What do we need to do?
Yeah, it's a massive challenge. That number is the estimate is 3.5 million new units over and above what we're currently building is what we need by 2030 across the country. No, across the country.
Okay.
For Ontario, yeah, we're in and around, I'd say 1.5 million units by 2030. It's a massive, massive challenge. The housing supply challenge, Brian, has been decades in the making, so it will take time to solve. There's no question about it. But we need to take a more holistic and coordinated, I think, coordinated approach to tackling this issue. So supply takes time to build. So that means when markets fail or behave irrationally, we need to manage both the demand and the supply side. We just can't turn a blind eye to the demand side either. And we need to do it in a coordinated way across different levels of government. But to close that gap, we need private sector participation. There's no question about it. We know market volatility can generate surprises for builders, and this could prompt a delay or cancellation of projects, which at the end of the day really amplifies the supply problem. So we need to create a more stable environment to provide builders with confidence, right, to initiate these projects. But policy needs to be there as well. And, I think there's some really interesting things going on across different levels of government, right? We've started to really take this seriously now. CMHC launched the Housing Accelerator Fund, you may be aware of, our viewers may be aware of. And that's all about incentivizing cities to break down structural barriers, to, allow, change archaic zoning rules to allow for more density, as an example, to expedite the planning approval process. So there are incentives there to encourage cities to act in a way where we're able to get housing built faster and more housing built over the next few years. But it's not just one thing that needs to happen, because there are a lot of causes to the problem. And so we need to do a variety of things that hopefully will translate into something bigger. But as I say, I think we can't turn a blind eye to the demand side either. We need to really understand the role interest rates play. We need to understand that while we do need more immigrants flowing into the country to offset an aging population, to grow our economy, we need to do it in a very measured way. We can't be opening the floodgates because we don't have the infrastructure to support that kind of growth. We need to do it in a more measured, steady way. So I think there's a lot that can be done, but I think governments need to work together to get it done.
Governments work together sounds almost like an oxymoron to me. I apologize, but I'm not hopeful in that regard. I do think that managing the demand side, and we've had lots of comments about this, whether it be foreign buyers or empty units, or the role of short-term rentals like Airbnb. We've had lots of I think finger pointing by politicians at demand side issues. Maybe immigration is the biggest of all of those, but we do need that immigration, and we know we need that immigration because otherwise there's going to be too few people in our country to work to pay for the old age pensions and healthcare that people need, and that's, I know, something that you and I talked about previously. I think it's all and if not all, almost all in the supply. And I think it is local government that has given into, I'm not sure what, whether it's NIMBYism or bad planning or outdated zoning or outdated urban design forms that have restricted dramatically supply, made the supply more difficult to get, to take too long to develop and get approvals, to put more risk in the approvals. I think that's the problem. And I think that we need to solve it. And I hope that we're on our way to doing so. Anyway, Ted, really appreciate you joining us. If people want to follow you for any of your brilliant analyses, is there a website they should go to, or follow you on LinkedIn or Twitter or X, or what's the best way to get the knowledge from you, Ted?
Best way I think would be through LinkedIn for sure. I'm fairly active on LinkedIn, and occasionally we post some insights on that page. So yeah, encourage people to reach out with their thoughts, open to ideas, and yeah, it's been,
thank you very much.
It's been great
That's our
talking
show
to
for
you,
tonight.
Brian.
Ted Tsiakopoulos, really appreciate you joining us. I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos are available on my website, briancrombie.com. Thank you, Ted. Really appreciate it. Good night, everybody.
Thank you so much. Take care.